What is going on, you guys, and welcome back to another video. Today we are going over 2 stocks to buy right now. I'd love to hear your opinions down in the comment section below. We're going to start with a Canadian selection and then bounce over to a US counterpart, if you will. In fact, I'm actually going to be buying the second stock in today's video. Plan on buying that tomorrow, just doing my final research, and when the market opens tomorrow, probably going to be taking a nibble at this one. Up on the screen, what you're looking at is a breakdown of the sectors of the S&P, and over the past year, the real estate sector at the very bottom has been a weaker performer, down 8.39%. If we look over to the Canadian market, we see healthcare utilities being the poorest, but real estate as well hasn't done all too well. It's essentially traded flat over the past year, and I do like from time to time to use this high level kind of screen to get ideas. We're diving into 2 REITs today. Drop a thumbs up if you like, by the way, but we're starting off with the Canadian option, which is Ryokan Real Estate REIT. The ticker is REI.UN.TO, trading for $19.28 per share. The forward dividend yield that we're looking at is 5.7%, so a great starting yield. This is obviously one of the major real estate funds or REITs here in Canada. They do commercial, a lot of residential as well, so a nice little mix. This, along with pretty much the entire real estate sector, has been victim to COVID, all right? COVID crushed this entire industry. The rising rate environment has been unfavorable. And in my opinion, a lot of the weakness that we've been seeing over the past couple of years has been kind of priced in. In fact, if we look at the performance over the past 5 years, it has been poor, in all honesty, just looking at share performance here. And that's okay, because in my opinion, the real estate market, thinking with my long-term time frame, yes, there are these short-term woes, but long-term Canadian real estate isn't going anywhere. And I think it might not be a bad time to buy into this weakness. I personally think Ryokan provides a safer dividend or distribution than some of the other REITs that you may look at. I do think there's a potential for this to grow, and we'll look at why in a second. And I want to pop up some metrics here that can be a little bit misleading. You know, if you follow the channel, you may look at a metric such as this, whether it's the compound annual growth rate being negative, or we see the payout ratio, which is just sky high, and that may be an alarm to say I'm not going to buy these stocks, and maybe so. But a reminder is that when we are looking at REITs, real estate investment trusts, we don't use the payout ratio. In fact, what we better look at is funds from operation, or the term FFO. If we look at that, we see that it's right at 60, which is actually directly in line with their 5-year targets, very sustainable. I just watched an interview this week, you know, as part of my research with the president of Riocan, basically saying that that's right in line with where they feel is long-term sustainable. They slashed their dividend back in 2021 by 33%, which obviously is a terrible, it sucks if you were a shareholder of Ryokan, you were depending on this income, but it does seem to be, I mean, in hindsight, it was the prudent move to get that, you know, the payout ratio in line, and as well that is going to contribute to the negative compound annual growth rate, right? When we see that over the past 5 years, you factor in all these numbers, yeah, that kind of explains some of the crappier numbers. However, over the past couple of years, let's say since the cut, looking forward, it seems as though they found a floor. They've increased this distribution from 8 cents, they bumped it up to 8.5 cents. They just increased it back in February of this year, 6%, to now sitting at 9 cents. And of course, these are monthly distributions. Management did comment saying that they expect this to be a range of increases that they are very comfortable with and can sustain going forward in this 6% or so range. So the yield has crept from nearly 4% right after the cut, when things were kind of sucky, to nearly 6% with the shares dropping and the yield increasing. More importantly, I think from this floor, things are moving in the right direction. Companies expected to grow EPS by 27% over the next year, and analysts do feel that the stock is unjustly underpriced. This is one of the top choices for REITs here in the Canadian market, one of the popular choices, and I know around my area, when I go see some commercial buildings, I do see the Ryokan buildings. It always makes me think of these guys. I actually don't own the stock, and it certainly would have sucked, excuse me, if you owned the stock and saw your income, cut down. Obviously, big bummer. But if you are looking for a new position, I do think that the floor has been set. They are kind of trending in the right direction, and I think it's a solid consideration. Today trading for $19.28 per share. Before diving into stock number 2, I'll remind you, in case you missed it, in less than 2 weeks, we are going to be in Calgary. So me, Mark, the Blossom team, Canadian in a t-shirt, a couple other special guests, I believe Zach Hartley and a couple other, influencers in that area. We're going to be at the Craft restaurant for the evening. And there's a link down below to come get tickets. It's gonna be such a nice evening. And for anybody that is in the Calgary or Edmonton area and you make the trip out, it would be very, very cool to see you guys. Very, very cool. We had an amazing event in Vancouver about a month or so ago. And then later in the summer, if you aren't in either of those areas, August 1st and 3rd, we're going to be in Toronto and Montreal. So we're kind of hitting a few major cities. And if you are in the area, whether you're a fan, a subscriber, a student, you guys know it'd mean the world to us if you made it out there and spend the evening with us. So there will be links down below for that. Would love for you to grab your tickets. Now, moving on into stock number 2. This is a stock that I actually plan to buy tomorrow. As I mentioned, this is a US REIT, okay? So Ryokan with Canadian. We're jumping over to actually one of my favorite, probably my favorite US REIT, hence why I own it. It is the ticker Realty Income Corp, ticker O, trading at $60 USD per share. A nice dividend, again, 5.09% today. I will be buying this in my RRSP. This is actually the only one true real estate play that I own. And in my opinion, it is the most reliable dividend payer available when it comes to REITs. They boast a portfolio of over 12,000 properties. Importantly, 75% of this, or 3/4, are in these non-discretionary low-cost clients. Feel free to pause the screen and take a look at some of the companies, but we have covered them before on the channel. These are some of the names, the types of companies that can help you sleep well at night, even during tough economic periods like we're going through right now. Realty Income Corp has provided a 14.6% compounded total return to their shareholders since 1994. Obviously, this is factoring dividends. There's a 4.4% growth rate, so it's a bit slower than Ryokan and other REITs. You're gonna find REITs that do, raise it faster. It's not massive, but it is steady, and I think steady is the name of the game here, just given the situation we're in with our world. You're actually gonna get a lot of contrasting opinions right now of real estate. You hear about the articles, you read about the future, the short-term future of especially commercial real estate. I'm seeing. I think it's not a bad idea to be slow and steady here, and importantly, this company boasts a track record of working within their means, 29 years of increases and 102 consecutive years of increases, 102 consecutive quarterly increases. They just bump this thing up time and time again, increase, get that dividend income up. Valuation wise, similar to Ryokan, 1 year performance, they're down. This is a sector that has been hit, down 13% with the broader macro weakness, higher interest rates, I think more or less just kind of punishing the entire area. We already looked at the quality of tenants, and I think that because this is such a stable and proven long-term play, I think it's not a bad idea to nibble here. Morningstar shows a 21% discount at today's dollars for Realty Income. Simply Wall Street showing a 34% discount for $60 USD per share. It's a happy addition for me, and like I said, I have a bit of cash in my RSP. I'm looking where to deploy. This is my personal choice. But hey, you should always do your own research and your own due diligence, and let me know what you think down below. Are these good picks? Do you guys like them? Do you dislike them? Are there better stocks to buy? There very likely could be, but these are just a couple on my radar that I want to share with you guys. If you're new to the channel, make sure you subscribe, drop a thumbs up if you enjoy, grab those tickets. By the way, link is down below. And of course, as always, if you are new to the stock market and you want to learn via an online training course, we have a community via our investing academy. We can take a DIY investor from start to finish, meaning I've never invested before. I don't know a single clue what to do. We can walk you step by step all the way to getting your portfolio built and getting everything set up and managed. There is a link down below for you to check that out. But as always, I thank you guys for watching. I hope you enjoyed, and I'll see you in the next video.